Hi everyone, welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. I am obviously running a little bit late in this one, so I do apologize. We did have some technical issues, so thank you so much for your patience. For those of you who are watching a recording of this on YouTube or elsewhere, please consider joining us live next time. You will have the opportunity to ask us questions during this webinar. Now, today's webinar is obviously mostly technically focused, but I am going to take a back seat in this one and let Victor, lead this webinar. I have a few technical issues on my end, so I don't think I'll be able to share my charts, but I'm going to do the introduction part, and then Victor will do most of the other section of the webinar. In the meantime, if you have any questions, please do not hesitate to ask us. Okay, so this is the risk warning. Please make sure you read this. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So for those of you who are new to this webinar, this is happening every Tuesday, 11:30 London time. As I mentioned, it's mainly technical analysis on major currency pairs, gold, and indices, but we do also touch on fundamentals as well, and there will be a Q&A session in the end. Okay. Now, in terms of the week ahead, we have lots of data coming up, and
oh man, what a week!
Indeed, yeah. I think that we have the US CPI coming up shortly, haven't we, Victor?
We do have the US CPI, which is, as you might suspect, one of the most important data points in this, in this environment where we're just waiting for the US central bank to give us more clarity about the tapering of asset purchases and interest rate hikes or whatever. Although, those are very, very far into the future. However, the market really knows wants to know when, how far into the future those are. So look at the inflation data with very keen eyes, because it might give you a lot of information, and very shortly. That's happening in just less than 2 hours.
Indeed, and we also have the earnings season unofficially kicking off today. Well, officially, whatever. We have JP Morgan, Goldman Sachs, the big Wall Street banks reporting their results. I think ahead of the bell, and then on Wednesday, Bank of America, Citigroup, and a few other ones. Morgan Stanley will be reporting on Thursday.
This is something interesting to speak about, just to jump in here. The earnings of major banks have been actually quite good during the pandemic because of record trading revenues. And let's see if, well, they obviously haven't maintained the momentum, but let's see if they have managed to grow their other businesses aside from trading, in order to compensate for the revenue lost out.
Volatility has been quite contained in the second quarter compared to the first quarter. So trading revenue should be lower. I think the major banks, they had put large sums of money away for in case the pandemic really had the consumer
went on,
they made losses, so for bad loans and stuff. So they are going to release more of those reserves, I think, to help their top and bottom lines. But most analysts, they don't expect the same results that they produce in the first quarter. So their earnings are expected to be lower anyway. But because the expectations have been lowered, it means that it's easier for them to kind of beat expectations. And Talking about individual companies, there was something else that came out this morning causing the Nasdaq futures to hit record highs. I think it was the EU. They were planning to levy this digital tax on major technology companies, especially the US companies like Apple and Facebook and those sort of companies. But now
they have pulled back from this decision. However, considering the fact that we have a global minimum tax rate negotiation, that was kind of expected, I would say, and the market is certainly overreacting to this.
Indeed. That could well be the case. And Nasdaq futures have jumped. Yesterday we saw the S&P 500 hit a record high. It looks like the Nasdaq is going to lead the market today. Obviously, a lot can change still because we have the CPI coming up and those bank earnings that could change the picture when the cash market opens later on at 2:30 London time. Just finishing off with this economic calendar, we have obviously mentioned the consumer price index from the US. We have CPI data from UK tomorrow, and as well as from, I think it's from New Zealand, yes, on Friday. So there's going to be some really important inflation data coming up this week. Also on Friday, we have the inflation expectations from the University of Michigan, which should be important because it will give you an indication of what the consumers are expecting inflation to be like in the months and years ahead. So that will be very important. I think the Fed is going to watch that data very closely.
In terms of central banks, we have a busy calendar once again. We have the RBNZ and the Bank of Canada tomorrow.
Yeah.
They are both expected to lean on the hawkish side. However, much of this has already been priced in my view.
The Bank of Canada is, sorry to cut you off. The Bank of Canada in particular, they have been reducing their quantitative easing purchases, and they're expected to reduce those purchases by a further I think it's 1 billion Canadian dollars, if I'm not mistaken, to 2 billion. So watch out for a reaction in the dollar CAD, because obviously oil prices have been going up and up, and the dollar CAD has been rising at the same time, but now it's reached a potential resistance area at around 125. Very important level this is, guys. So with the Bank of Canada potentially being more hawkish this week, this could lead to renewed weakness for the dollar CAD pair. So that's something to keep a close eye on.
So on Thursday, we have more important news for commodity currencies, and namely for the Aussie with the employment report out, and Chinese GDP, which is, China has been for years now the world's leading consumer of commodities. So that's something to watch out for if you're trading commodity currencies. Now, shall we move on? Yeah, we do have some second tier data in terms of UK average earnings and US industrial production as well on Thursday. And the Bank of Japan policy decision on Friday, which typically doesn't yield any surprises. They just keep pumping those prices.
Indeed. Do you want to share your screen now to share those charts? Yeah. So let me just see what I can do. I'm gonna end the share. Stop sharing. There you go. You have the control of the screen now, so you should be able to share your monitor, your screen with us.
Yeah. Do you see my charts?
Not at the moment. It says yes. Now I can see your charts.
Okay.
Yeah.
So we are at a key juncture in the euro dollar and, well, in pretty much any other dollar pair at this moment, probably aside from the dollar Japanese yen. But let me circle back to the euro dollar. So looking at the weekly charts, we have been consolidating in this triangle pattern on the weeklies, and we have been testing the base of this trend line here, near 117.80. We haven't managed to probe below that trend line yet. So that's something to watch out for. Moving on to the shorter time frames, we have been, and just before the CPI data is released, we are in this tight range between 1880 and 1840. So I would look for, honestly, like the key levels would be to, the key action would be around these levels. And if we make a, probably, like, in my view, a lot of the CPI is, there is an increased expectation that the CPI is going to be high. So if we get a high CPI number, that doesn't necessarily mean that we're going to drop lower in the euro dollar. Of course, if that number is crazy, like 7% or something, I don't know. But I don't expect that to be the case. We might probe below 1836, and we might test the 1880 area again. So for a more confident position, I would be watching at these levels, and price action should be the driver here, because fundamental news, while widely expected, may have been widely priced in. So
in terms of CPI print, would you say like something above I don't know, 5.5% on the headline would be really bullish for the dollar?
I would say 6% could trigger a gap lower.
Yeah.
Something like that.
But anything in line is probably not going to cause too much of a move, I wouldn't think. Also, on the subject of CPI, I think it's worth looking at the detail. It's always the devil in the detail, isn't it? Of the inflation report. If inflation has risen by factors that are considered to be temporary, then the market is possibly going to shrug off any strength in inflation, as they have done so in the last few weeks with bond yields going down, etc. If it's other factors supporting inflation, then that may raise a few eyebrows and possibly lead to a strength for the US dollar. But generally speaking, with the stock markets going up consistently, with yields falling, it looks like the FX markets may be able to join the stock market rally in the sense of selling the dollar and going long or bed the commodity dollars like the Aussie, the Kiwi, etc., the Canadian dollar. So that's my expectations, but let's see what happens.
Yeah. So moving on to the British pound, we have a similar price action actually, and the base is around 38.40. Let's say this is a previous high, which has served yesterday as a support level, and this kind of longer trend line has been broken. However, price action failed to hold above 139, so we have a triple top of 139, and that's probably a level to look out for if we break through there.
For me, the cable right now is at the key support. If you go back to that chart, I was just gonna. This area right here was the last downward move prior to. Can you see the annotation I've done on the chart?
Yeah.
So that was the last downward move prior to price breaking out, right? So the low of that area is right here at 138.20ish. If you're bullish on the pound, you don't want price to go below that level now. And yesterday we came down and bounced right at that level, which was also previously resistance. And we're coming up to this area again. It's being tested as we speak. So it's possible the cable could be forming a low here, leading to a break above these equal highs, where lots of stops are going to be resting from people who are short the cable. So could we possibly see a massive move higher today to trigger those stops?
Quite
It's what
possible.
I'm thinking. Yeah.
So looking at the Aussie, we have very similar. Can you
Let me
clear
just.
those annotations?
Yeah. Let me just clear those. There you go. Clear all my drawings. Yeah.
Great.
Clear my drawings.
So the 75 area has been strong, like 74.90, 75. We had the Aussie show its head above 75 early early morning today, and it has fallen back below it. However, if we are to see further bearish action, we would need to take out this area here um, with actually a potential inverted head and shoulders forming with that show below 74.50. If sorry, am I annotating?
I'm not seeing anything.
All right.
Yeah.
Yeah. So this area
Yes.
here would be the head, and we have one shoulder and another shoulder potentially.
Yeah.
This could be some. This could be a bullish reversal on the Aussie.
It looks like
On
it looks
the
that way, doesn't it?
Yeah.
Yeah.
So on the longer time frames, we are seeing somewhat of a similar price action. Let me just So
wow.
basically, we had this. Let me remove this one. So we had this test of 74.12, which was a previous low marked back in August 2020. So we have tested
Previous high, yeah.
that area, previous high, sorry, yeah.
Yeah.
We have tested that area, and so far we're holding above it. So price action dictates that this could indeed be major cross point, having in mind that we are spending between 76 and 74.50 fourth week. There is a lot of order flow, buyers emerging at the lows, hires emerging around 76, sellers emerging at 76. So we are at a key juncture here, and a decisive break above 75, in my view, would open the doors towards another test of 76 and possibly a reversal back to the 77, 79 levels, even assuming that Jay Powell doesn't drop a bomb on Wednesday, something that we actually didn't mention this in our calendar.
Oh yeah.
He's testifying. Jay Powell, the head of the U.S. Central Bank, is testifying in front of Congress on Wednesday. So that would be something to watch out for, and could be quite important for the markets. Moving on to the Kiwi, we are seeing. Oh, sorry, these are some very old drawings here that I have. Yeah, we're seeing a very similar picture to the Aussie. We have tested this level around 69.40 3 times now, and we keep bouncing. Looking at the hourlies, we have resistance around 70.10, which is quite pronounced, and support levels that are basically just above 69.70. We'll let's say that this would be a level to watch. It was the pullback low yesterday, and it's crossing with a rising trend line. So that's an area I would be looking at to go bullish on the Kiwi.
Yeah, I agree with that. Again, very nice equal highs here. Usually, when I see things like that, I don't think double top. I think that's where the market's going to go to next, because of the way usually it's double tops and double bottoms don't usually work. I very rarely do they work, in my view, in my experience. More often than not, double tops and double bottoms are typical retail minded patterns that everyone else is looking at.
Yeah.
So doing the opposite is sometimes, thinking outside the box and doing the opposite of the conventional wisdom is what makes a difference in terms of your profitability as a trader. So, carry on. Should we look at a few commodities now, or have you got any other currency pairs in mind?
I was actually gonna revisit the Canadian dollar. And look, your annotations work just fine here.
I don't have to change my drawing.
Yeah. So basically, we're seeing this this pair pulling back from the high.
Yeah.
And testing some trend line levels this morning. I think that the price action is basically inverted to the other commodity currencies that we
just 1 second on this chart before you move on.
Yeah,
I was gonna draw a box here. It's possible that we could move up into this box and above this high here momentarily before the selling pressure resumes, because sometimes when you look at the key levels like 125, it's a very important, psychologically important level for the market, and usually you get lots of deviations around it. So don't be surprised if you see another spike through it and then a rejection down on the downside. And if you go to the daily chart, Victor, I was gonna clear all the drawings. Okay. This box right here is where the last upward move failed, right? This is precisely where the buyers got trapped last time on the daily time. So around this area, it's where I was expecting the next leg lower to start, because people who were trapped here, they will have used the recent rebound to come out of that losing position at break even. So I'm expecting the dollar CAD to turn lower from around here, and we may already have seen the first glimpse of a reversal, although it remains to be seen whether we'll get some downside traction now below that level or not. So yeah,
as you can see, the base around 24, 40, 50 is pretty important. Like prices have visited this level many times. Like we have this area here, and then this area here, and then these two.
Yeah.
Oops, sorry, that was a bit wide. But anyway, you get the idea. Let's move on to commodities, shall we?
Yeah, go on then. There is a question, Victor, from HH Hassan. BNG said that it is expecting correction in asset prices. Could you comment?
All right. Shall we go on to the asset prices then? I mean, to indices.
Yeah, go on then.
Right. Just a second. Let's go to indices, and we have the German DAX, which is probing
all-time highs, yeah.
All-time highs, and very, very slowly grinding at these levels. We have seen a bear trap last week,
Yeah.
which played out pretty nicely for the bulls.
That was the seller's opportunity to really drive asset prices lower, because prior to that move down, all the indices had been trading inside a tight range, and the markets, when they sold off, I thought this could lead to a small correction. However, there was no downside follow through, and immediately the sellers got trapped once again, and we moved higher. And yeah, I to kind of try to answer your question, Hassan. We are expecting, well, I certainly am expecting asset prices to correct. It's just a case of timing, and when will that happen? When it happens, it will happen really fast, and you'll know it because the markets will be making lower lows, lower highs, and selling off really sharply. It's always best to be prepared for that eventuality because it will happen. However, it doesn't mean that you should be trading the market short right now, because or being scared to go long at these levels because of your of the possibility of that big correction. So the way I would proceed is, given how the markets recovered really strongly, last week, I would still be looking for bullish trades in the indices, but I will be wary of the possibility for a sharp correction, given how high asset prices have become, and the possibility of the Fed tapering QE, etc., etc. So I would be looking for long trades until the charts tell me otherwise. And in terms of my targets, I would be a little bit more conservative rather than aggressive targets on the upside, and keeping my stops tighter than I would usually. That's the way I would proceed, trading indices.
So let's discuss briefly the Dow Jones Industrials Average. It has been trapped in a range for some time. We have actually closed above that range yesterday. For the first time, we have a daily close this high in the Dow, and it's very hard to go short here, just because when from the perspective of a trader, it might feel logical to try to look for this corrective move lower when the market is making a new all-time high. However, you don't want to chase this. You might spend months chasing this correction, and it's not worth the risk, simply because when bears give up and start covering their short positions, just as it happened on Friday, this candle here. Sorry, I'm not drawing, am I? Just a second.
I actually got caught in that short squeeze on Friday. I was short based on price action previous to Friday's rally.
This candle here is what I'm speaking about. It's really it's a really nasty move, and just when you think that this is it, finally the market is going to correct, it rebounds and erases all of your gains, if assuming you went short earlier. So that's to answer your question, Hassan. A correction in asset prices is possible at any point in time. Timing it is extremely difficult, and the only way you can do it successfully, in my view, is basically wait for these very sharp moves higher, not the grind.
Yeah.
Like if you try shorting the grind, you're guaranteed to be grinded. But if you see a very aggressive spike higher, then you can try with a very short, with a very tight stop loss, going short and exiting obviously at the right time, just not to get caught in that move.
Let me add here, because this is a really important point you raised here, Victor. And every time the market spikes in one or the other direction, like for example here, it's basically advertising to the buyers. Buy me now. It's going to skyrocket here. And as soon as people buy it, look what happens. It went down. Again here, the market was selling off really sharply as it broke this low here. Once that low broke, people will be like, oh wow, it's gonna break down. But look what happened. Boom, it went the opposite way. Here as well, big move down, took out this low, and then a quick rejection, and look what followed. So what Victor is saying is, look for a massive rally, like a spike higher, and then look to fade that once you see a reversal on the shorter time frames, if you want to short. Another point I want to make is, because of the amount of times the sellers have been unable to exert pressure, each time there's been a bit of a downward momentum, like here, for example, or over here. This kind of underscores the view that you should always look to go with the trend rather than against it in most cases, because looking at this, the trend has clearly been bullish. So you're automatically giving yourself a better chance of making a successful trade by looking for long setups because of the bullish momentum than going against the trend. So also going long, the market will give you lots of opportunities to come out if you make a mistake. For example, let's say you went long here, and then the market crashed and went down a little bit to hit this trend line. But for some reason, you managed to stay in the trade and didn't close your long position. But the very next day, it gave you an opportunity to come out of that trade that you had taken around here, for example, to come out at break even, or hold it, and it would have turned into a profitable trade. And that's the beauty of trading with the trend, because the market gives you lots of opportunities to correct your mistakes. But if you get short and the market continues to rise, then it can be a nasty experience. And I have been in the receiving end of that a couple of times. You don't want to experience it.
Yeah. So shall we move on to look at the Nasdaq then?
Yeah, go on.
The Nasdaq is just relentless. It keeps rising and rising. There is no end in sight, and that's kind of worrying for the bulls, I would say, because you see how sharp of a move this is. That we have this trend line, which is so steep, like and it's been going on since the middle of May. We haven't had a meaningful correction in the Nasdaq at all during this time, and that's something to watch out for. However, don't like we already discussed, don't place your chips on that. Just look for a sharp move in either direction and then take a decision.
Just as a side note, what I was talking about in terms of retail-minded thinking. Here you had a head and shoulders pattern, right? The left shoulder being over here, the head, and the right shoulder. Look what happened when the market broke down below the neckline. You should have expected it to, on the retest for the market to then collapse from there, right? But instead, what happened? It reclaimed the neckline over here, and it went above it, and then it consolidated for a while before taking off again. So it all started when the sellers got trapped right here, and that was the early indication that the market wanted to go higher. And we saw subsequent traps here, for example, price and the index unable to hold below the previous low. lots of similar setups have since emerged, and you have a double top here. This one did work for a bit, but then look how the market came and stormed right above it, because a lot of people have been caught short, and there's not many sellers here. That's why the market continues to grind higher and higher and higher. Eventually, obviously, it will top out, but don't try to fight it, because the bubble can inflate a lot larger than you can imagine before it starts to deflate. So yeah, that's I just want to add to what Victor said there.
All right, so shall we move on then to another chart? Let's have a look at the at gold prices, which have been also quite interesting in terms of consolidating in a timed range. So what
in other words, not very interesting.
So what I have highlighted here is this range trade between 1815 and 1790 roughly. We keep on chopping in both directions, and there is no really clear move here for the time being. So if you're bold, you can try trading this range. I wouldn't, just because.
Yes.
Sorry. Just, that's a price alarm that I have to turn off on the other computer. Can you take over?
What's that? The S&B, is it? Yesterday, the price of gold fell quite sharply in this hourly candle, and then it got rejected immediately after that. So this is an indication, in my view, that perhaps the market wants to go higher. And if you look at the
that candle yesterday was pretty impressive. I gotta say.
So this zone right here, the sparks have drawn. It's where on the short-term time frame, you can see that previously price was finding resistance, and now it's offering some support. If you're bullish, you don't want price to go below this box now. I think if it all depends on the outcome of the CPI, or to some degree anyway. If CPI comes in a little bit weaker or in line with expectations later on, then I reckon gold is going to break out.
Yeah, we have a great question from H. Hassan actually. Can you anticipate inflation? Well, you certainly can, because before inflation shows up in the data, it's usually hitting your pocket. So looking at prices around you and taking note is probably not a very bad indicator as to where inflation is going. Although you have to take into account that official inflation statistics are usually normally skewed lower. So you're going to see prices rising higher on the street than on the screen, if I may say so. But inflation trends can be anticipated by looking at prices around you. And obviously, we live in such a globalized world that regardless of where you live, you would have a reading, a sentiment on about whether it's going higher or lower.
I think inflation is going to be a major concern for emerging market economies. In Turkey, for example, it's really bad, the situation there. The Turkish lira is hovering near record lows. In South Africa yesterday, there was lots of protests going on. Obviously, that was in part because of the imprisoning of the former president Zuma. But people are taking to the streets because of hunger, because they can't afford prices. Commodity prices have been going up really sharply this year. They have come down a little bit, but crude oil remains high. That is going to add to input costs, and factories and manufacturers are going to pass on some of those raised input costs to the consumer eventually. So you can predict it, and economists have been predicting that inflation is going to go up, and inflation has gone up. The key question is it going to be sticky or is it going to go down from here?
Let's have a look at the one key driver of inflation figures, which are oil prices. So we have on the monthly chart, we have hit this key level around 76.80 in
WTI.
In WTI. So that's we have seen a pullback since, and another rebound that was halted yesterday at the same level where it that it hit last Thursday, I think. So we have 74.85 as a very kind of important level. The rebounds have been shallow, I would say, for now. I mean, it's been a week since that OPEC debacle. And prices haven't moved higher, as we have discussed at the time. We did see this spike higher, which was followed by a drop, precipitous drop that lasted over 2 sessions. But we could see a resumption in this decline, don't you think so?
Yeah, I just drew a line while you were talking before. There's blue level here. I don't know what that exact level is. I think it's 72.80ish, something like that. The reason I drew that level is because it's 72.70. Yeah, it was the last low. The last downward move on the 4-hour chart prior to price making a higher high above this high, right? Is a small higher high. So therefore, if that level breaks, then it could lead to a resumption in the trend. Notice also that we previously had a low right here, which was taken out. So we may have formed a lower low. Well, we have formed a lower low. This could well turn out to be our first lower high. Yeah, but in order to trade a short, the best opportunity would have been to trade it short here, and I traded this actually myself. But now that we've kind of broken above the 72.70 level, which was pivotal, right? What you want to see is confirmation now. So I want to see price of oil going below this level, and then what you could do is obviously price will have created a structure somewhere around there, or maybe here. And what you could do is possibly look for the market to go up, and then you can sell that potential retest to take us to a new low below this low. So that's the scenario I'm looking at for now in terms of shorting crude oil. I'm not really entertaining the bullish trade idea at this stage, because while I think that it's possible oil prices could go a lot higher than from here, it's just that I think it's getting to the point where the risks are now skewed to the downside from a short to medium term time scale, because of the fact that the demand projections that people have been saying that demand is going to be really strong for oil, that has been priced in. The rising cases of coronavirus, the Delta variant, that's going to impact demand, I think, a little bit. Certainly in places like India, one of the largest oil consumers in the world. And then you have the OPEC and UAE, who are who want to kind of raise output. So there's a lot going on. I think because of this uncertainty, I just think that it makes sense to be more hesitant on looking for further bullish price action in crude oil. and I think that the greater move could be to the downside from these levels.
Yeah.
Could be wrong.
I feel like we're on the same page here. Shall we have a quick look at silver before we go?
Sure.
So what we are seeing on these charts is that silver has been, whoops, sorry, haven't visited this chart in quite a while.
Just as well, because silver hasn't done anything, right?
Yeah, so we are consolidating in this pretty tight range for silver between 25.50 and 26.50
yeah.
Over the past several weeks. So in these ranges, it's pretty difficult to take a stance. But if we are to look at some technical levels, I would say that the 26 area appears to be where demand is at present. We have visited these levels, let me just roughly 25, 95, 26. This is the area where demand surfaces and pushes prices higher. However, sellers are also not dormant and waiting to take the other side of the trade. So yeah, for the time being, we're still in consolidation mode, and a break below this 26 area, and namely 25.50, I would say, is the more important one, which is also coincided with a rising trend line, is going to be the area to watch out for. So yeah, this area here is where you wanna place your buys if prices goes there and you're bullish on silver, which I'm not necessarily saying that you should be. This is pretty much it from us for this webinar. We have had a look at most major asset classes. If you have any questions that now that we haven't addressed, now is the time.
Yeah, I can't see any questions, Victor, from the attendees that have been kind enough to join us live. Thank you so much for those of you who have joined us live. Please ensure that those of you who are watching a recording of this, and if you liked the way we analyze the markets, to join us live next time. And this webinar is going to happen at the same time next week. All the details are on our website. If you go to thinkmarkets.com, then you would see a list of webinars under the market analysis section. Okay, so please ensure to join us then, and have a great week ahead. Take care from us.
Take care. Thank you for joining us. Bye-bye.